if you are a market structure trader, a supply and demand trader, a Fibonacci trader, a trendline trader, a support and resistance, or smart money concepts trader. A long list of the most common strategies. But have you ever wondered, if you trade those strategies, that you get the direction correct time and time again, but price just hits your stop loss by a few pips? At times it might just feel like bad luck. This is part of the plan, or we can't win them all, or we have to actually question things and look deeper. Because you see, not everything is just bad luck. Sometimes it's a lack of understanding of the real language of price. And in my 9 years of trading experience, I've seen this key language come to light and get stronger and stronger in recent years, and that is liquidity. And therefore, the more liquidity we see in the market, the bigger the opportunities that come right after it. And when I discovered the key components of what a liquidity sweep is, which I'm sure you're familiar with, versus an inducement, something that is similar, but the inducement is the one that's actually the one you need. Because with inducement, I'm not just talking about another strategy. I'm not just talking about another school of thought or theory. I'm talking about the primary driver of price, the language of price, and the only real truth in the market, in my opinion. And in this video, I'm going to give you a full blueprint and guide, breaking down exactly what a liquidity sweep and inducement is, the criteria, the types, with case studies, examples, and we're going to take a look at it from an institutional perspective by truly understanding the narrative, intent, control, and why liquidity enters the market, how we can identify it, and who is contributing towards these liquidity pools. So if you are tired of being in the 6 million trader category, that is the 97% of traders that consistently lose money, and you want to transition towards the edge that the top 3% of traders have, the 180,000 of us that truly understand that the market is not a game of correlation, it's a game of causation. What causes the market to move, and the biggest principle of cause and effect will always be liquidity and inducements. So welcome to the right side of the market. This is not just theory, this is actually how the game is played. So the liquidity trading guide, as you can see in this mind map, there's a lot of things we need to dissect, from examples to setup criteria to what is the types of inducements, and a whole flowchart of sequence of things you need to know. And therefore I need you to have a pen and paper ready to take notes and ready to digest this liquidity trading guide. Before we get into it, you might be thinking, well, why am I going to waste my time listening to this guy on the internet? Who is this guy in front of me, and why should I trust what he's saying? So my background is actually qualifying as a dentist. I spent 6 years at university to gain my doctorate title, but by the time I had graduated, I was already a millionaire because I started trading within my first year of my degree. And because I didn't have the pressure of making money right away, I focused on learning strategies, learning intentions, and learning how the market really operates. And fast forward now, 9 years later from when I first started trading, and having multiple millions of dollars to my name from the markets directly. If you haven't, go and check around this channel. But the main thing that I want you to understand is the way that I've been trading for the last year and a half is in a very specific way. And in the last year and a half, I've been documenting all of my trades live ahead of time with my public track record, documenting on average 5 to 6% gain per month across a 1.5 year period to give a substantial gain. And you already know the power of prop firms. For example, if you had $1 million in funding, which I've helped countless people do within my community, just 5% gain per month is smashing through a neurosurgeon, a dentist, a lawyer's salary by a mile. This is not a game of crazy returns. Trading is a game of understanding high probability confluences, causations in the market, small, consistent, profitable gains of 3, 4, 5% per month, and having large capital. And that's exactly the roadmap I took to make the millions of dollars that I have in my 20s. And before I share all of the knowledge that I've eagerly prepared for you, what I want you to do is actually go ahead below this video and download a free resource that I have for you called the Risk Management OS. It will be free to use for the rest of your life. I don't need anything from you. It's just important for you to understand that when it comes to risk management, one of the biggest problems that traders have is blowing their accounts, blowing their prop firm challenge in a single day or in just a few days, because they don't have AI, they don't have systems and protocols in their favor to tell you what to do in a losing streak, to what to do if you're 5% or 10% up on account. If you're going through a winning period, what should you do with your risk? How should you calculate your loss size adjusted for your journal and setup types? And what are the key metrics that you need? I created and engineered all of this, something for myself that helped me build my public track record and give the trades that I gave live ahead of time. So go ahead and download that with the link below. Now let's get right into this video. So the liquidity trading guide, I'm going to be focusing on the word inducement, something that we pioneered, and we've been using this term since 2019. And if you look back, That word has now become a buzzword in the industry, but no one was saying it before 2019. And why I want to separate a liquidity sweep from inducement is because inducement has a lot more going on, a lot more importance, and the reality of the market. The idea behind an inducement is to incentivize the masses on the wrong side of the market, meaning you invite in liquidity through traps, through belief systems, and then take them out. But it's not just targeting one style of trader. That's not realistic in the market. It's going for maximum impact by taking out pretty much everyone in the market and only allowing the big players to remain. That is the difference between a random run of liquidity and a real meaningful inducement. And therefore, my whole trading system, every single trade model that I have is always around inducements, whether it's a reversal model or a continuation model. And with the hierarchy of confirmations I have from A+ all the way down to a C+ setup, whether it's a counter trend intra-session trade or a pro trend intraday trade, I have everything categorized. And every single one of my trade models, it requires, it mandates, it's a necessity to have an inducement involved in my analysis. And therefore, you might be thinking, well, direction in the market is through market structure. And if you've watched some of my previous videos, I've already dispelled that market structure is good. It gives you an indication, but it's not the be all and end all because you don't understand narrative control and intent. And the right direction in the market is not always market structure, because if you have the daily bullish and the 4-hour bearish and the M15 bullish and the M1 bearish, what do? You have all these mixed opinions. Well, the reality is direction does not equal market structure. Direction equals what liquidity says, whether that's on a short-term horizon of the next 15 minutes or a long-term horizon of the next few weeks. Everything boils down to inducements and liquidity, because that is the oxygen and fuel of the market. And we're going to be exploring the types of inducements, but for example, if we focus on the medium inducement, there's going to be types that are going to be POI based, point of interest based, where we are looking for a mitigation of a point of interest and a lower time frame confirmation to look for a reversal model. That's going to be your point of interest based. You can also have non-POI based when we are not mitigating, rather we are targeting liquidity or going towards a mitigation, and therefore a continuation model can be found where you're not trading with points of interest or even market structure. You're simply trading with inducements and time and confirmation. And those are the two variations that we have. And another way you can qualify your inducement, something we're going to spend a lot of time on, is time of day, because the time of day is when you can find maximum volatility, pair that liquidity to make the best opportunity. And therefore we find high probability zones where we can actually leverage our money with high risk reward, with high probability, therefore a high win rate, to actually find an edge in the market, which is the real job of a trader. Carve out high probability opportunity, find a data backed edge, find profit taking systems, and find risk management systems, and control it all with your psychology. These are the key foundations, and inducement and time connect all of these dots together, because high probable environments equals the correct time to be trading. I'm going to be showing you the exact key windows later on, and those are going to boil down to the London window opportunity and the New York window opportunity. I'm specifically speaking about Forex major pairs, let's say Euro USD or GBP USD, the exclusive pairs that I trade. There are going to be key times within there, not the full session, key moments. For example, a Frankfurt Open means something, Asia high, Asia low means something, London Open and the first hour means something crucial, and then the New York Open, sometimes it can be a trap. And then you have your New York key window and even a London close. These are your markers of the day, and these frame the narrative and frame the daily cycle, where then market structure and other things fall into place around these things. And these key windows of time, when you pair time of maximum volatility with the inducements that we seek, then you can actually find your continuation models or your reversal models, and these are going to be the types of trades that we look for specifically. And there's going to be multiple variations and categories under here that are going to be your exact trade models. So now let's get into some of the key components of the liquidity trading guide. First one is going to be the law of cause and effect. First of all, here, a key thing that I need you to visualize is the elastic band effect. Now, the elastic band effect is something that you need to ingrain in your mind, because before you take a trade, you need to visualize, has the elastic band been stretched? And when I let go, is there going to be enough of a reaction to go exactly where it needs to go? If you are randomly at a support level, has the elastic band been stretched? If you are randomly at a trend line, if you are at a demand area, you have to think, okay, I'm in zones of interest. These are where traders usually get involved. But has my elastic band been stretched? Has it been let go? And is there enough movement in there for it to go towards the target? The elastic band effect will help you visualize the law of cause and effect. And the law of cause and effect in the market dictates that every significant move in the market, therefore effect, is preceded by a buildup of tension. That is the cause. Like the elastic band, you pull it back to get the cause, you get the tension, and then when you let it go, you have the effect, which is a significant move in the market. And if you are wanting to trade any portion of the market, you should probably trade the significant moves in the market, because it goes towards your direction in a fast manner with the real liquidity and institutional movement with high probability, high high risk to reward, you want to understand the law of cause and effect, because every major move in the market proceeds with tension. So what is that accumulated pressure? The purpose of this video, understanding liquidity and inducements. And therefore, for us to maximize this understanding, we have to think that the more the pulling back of that elastic band, what that means is more and more engagement of liquidity, more people getting into the markets, more people invited in from their beliefs of their strategy, and then more and more stop losses taken out. The more stop losses we take, the more violent the liquidity sweep, the inducement, the more likely it is to have a meaningful move in the market. And therefore, for us to really understand how to maximize our trading, we have to understand, where do these key liquidity zones, stop loss zones lie, and how can I understand the signatures of real inducements? This is the key to everything, because once significant liquidity has been taken, that's when the market is going to move with intention, move with momentum, and move towards real direction in the market and trading impulses, as opposed to random choppy price action zones where you can caught up taking a lot of losses and end up frustrated because price is not doing anything. Because think about it, once you have stretched that elastic band and you let go, it doesn't just flop back to equilibrium. It doesn't just go back to normal. It goes back in an equal force in the opposite direction. And that's when you have meaningful moves. And that's the whole point of an inducement. You're not just going back into the zone, back into a range, back into consolidation, back into choppy price action. No. You load up into the rocket and you fly with price, and that's the best way you should be trading, because you're trading pro-trend impulses despite whatever market structure might be telling you. And therefore, for us to really maximize this, we need to know what is the cause and what is the effect. And we're going to be getting into this in all of these later on steps to understand what are the causes and how to qualify them, to know what is a correct effect, to then find how to actually get into these trades. So here we need to understand what is manipulation. And manipulation is going to be of certain areas. The key ones that I like to focus on is support and resistance, the classic double bottom, double top. What's that going to look like? Is typically speaking, when price action is in a zone, we are consolidating horizontally. You have multiple touches of a low or multiple touches of a high. Therefore, we have found a resistance level, a ceiling in price, or a support level, a floor in price. And we know around these common areas, there's going to be a lot of liquidity above of the sellers who are selling in these touches and putting their stop losses below, or in the floor, the support level, you're going to have all of these buyers entering the market and their stop losses are going to be in this area. So when we see price action like this, we know that right above and below there is a liquidity, and therefore support and resistance no longer means opportunity. It means trap, because price can trade out to target it, and once it's taken it, the elastic band is stretched, then it goes for the next pull. So this is like stretching the elastic band, creating that tension. Once you've grabbed all of that liquidity, you let go of the elastic band and it gives a forceful move to the other direction and targeting the next liquidity pool. And why does this happen? Because previously price could not break this level. It was holding in this area, but because of this inducement, this liquidity sweep, because of the elastic band, this was now enough force to now take out this previous floor in price and make a new low. And this doesn't only apply to support and resistance, this applies to trendline trading. And there's going to be many types of liquidity pools, like high of previous day, low of previous day, high of previous week, low of previous week. In fact, even session highs and session lows, Asia ranges, major structures, intraday structures, all of these points, that common areas that traders are going to be involved. Market structure zones, supply and demand zones, trendline zones, Asia high, Asia low. There's going to be so many areas where liquidity is going to be heavily pinned because of novice, uninformed traders' activity. And therefore, around all of these areas, there's opportunity for tension to be created, the elastic band to be stretched, and therefore inducements to be found. And therefore, what that means, if we connect inducement with time and confirmation, that's the holy trinity, the trifecta that I always speak about. That is the key to profitable trading. And what that can look like, for example, in a trend line trader, it can be a ascending trend line. You have multiple touches, and then price is coming to the next touch. It gives a small reaction to entice people, to get people buying again. And we know that their stop losses are loading up all in this area around this trend line. Once they are invited in, they're excited, they're emotional, they're happy, they're jumping in, over risking, over leveraging. The market simply needs to go lower to grab their liquidity. But this is why it's an inducement, because when the market does go lower, other traders get involved. They think, oh, we've had a bearish market structure. We've now got this supply zone. They're going to start selling from this area, hoping price goes lower. And therefore, where are their stop losses going to be? All in this area. So when the market does an inducement, pulls the elastic band back, we take the stop losses of the trendline buyers, and then we take out the sellers in the other direction. So we took stop losses of this area and stop losses of the sellers. And that's why we call an inducement a real intenseful move in the market, because you trap everyone out. Market structure traders, trendline support, we get everyone out. Fibonacci, EMAs, doesn't matter what indicator you use. If you don't understand inducements, you will fall frustrated and you'll fall to many losses because you don't understand that the market is doing the law of cause and effect. And my favorite one is going to be traps. And traps happen around key trap times like Frankfurt Open, and they happen to specific strategies. My most preferred one is smart money zone traps. We made a whole guide on it, so go and watch that video. But we can see how we can understand where smart money traders' interest is, where their liquidity is, and where smart money liquidity stop losses lie, and those traps to induce smart money traders before real high quality moves. Go check that video out after this one. Now, the key to all of this is understanding what is something that looks like an inducement and what is actually an inducement. You need to have qualifications. You need to have criteria and rules in place to say, this is not a feeling. This is not a vague thing. This is a science backed by data. And we need to know exactly what we look for to qualify what is an inducement versus a random sweep of liquidity, a random pattern, a random head and shoulders. No, what is a real intentful move? And that's going to come down to breaks of structure. So for example, if we have a buildup of liquidity, we have a support level formed and the buyers are loading up on this reaction. Then the market goes low to grab their liquidity. We've stretched the elastic band now. We've grabbed the liquidity now. Therefore, we need an effect. We need price to actually give an effect, meaning we take out structures. We have bullish breaks of structure, because if the market did all the effort to take that liquidity and then just gave this little reaction, that is not enough of an effect for us to be convinced that market actually took liquidity, or that liquidity was just simply absorbed and not relevant because there's maybe too many sellers in the market, that the buyer's liquidity getting taken out was not enough of a move for the real players. So we need to find confirmation, law of cause and effect. You find the cause, which is an inducement, and you confirm it with an effect, which is a break of structure. And once you see that break of structure, then you come back to find an opportunity that you can trade, and that's going to be with confirmation and time, and therefore that becomes a potential trading opportunity to buy after the inducement and after the mitigation of confirmation. That's something I'll break down in detail in just a moment. And to confirm this even more, within these areas after the inducement, I need to see this is in a key time window. We have a key lower time frame confirmation like a break of structure bullish. So we formed a lower high, lower low, higher high, higher low. And with the break of structure, time confirmation, lower time frame confirmation, we also need to see other things like imbalances. In this area, I need to see large bullish imbalances, large engulfing candles, and of course with momentum to show me that the elastic band being stretched and being let go led to a forceful and intentful move, hence my intent criteria. But just so that we don't fall victim to just trading patterns and what price visually looks like, we need to also have strict criteria of invalidations. Invalidations are going to be my key ones: efficiency of the pullback. Watch the video made about that. Time, once again, is going to be a key invalidation for me, which is why I have key trading windows that I don't deviate away from. My London window, 1 hour of the day, my New York window, 1 hour of the day. These are the only 2 times in the day I'll trade. The rest of it is not for me. And that way, I don't need to be glued to the charts, obsessed with every candle. I just need to look at the market for 2 hours a day. If an opportunity of an inducement with confirmation happens in my time window, then it's an opportunity for me. If it doesn't, it's not for me. Then the other thing you need to understand is counter-inducement. And this is going to look like, let's say you have a build-up over here, and then you have an inducement low, and then a reaction in the other direction. So you've had a build-up, you've had an inducement, and you've had a break of structure. So you're thinking, oh, perfect. Now I just need to look for a buy in this area, and I just need to now do that trade that we mentioned earlier. Well, not quite as simple, because you have to also consider the counter narrative, which is, what if this was a build-up of liquidity, that resistance level, and now this is the real inducement, and price might now go lower, come back over here, and then go low overall. And therefore, that's why we have these inflection zones. Again, watch the videos I've made about this topic. I should not be trading in this area that is an inflection zone, because inflection zones are areas where you can have a bullish outcome and a bearish outcome, and they overlap in the same area. So if you're in that non-confirmed inflection point, don't trade. And that's why we need to be aware of counter-inducements. And then the last thing is structure or liquidity or smart money traps. And that's something a little bit more advanced, so I'm not going to cover that in this video. But just know that there are many qualifications criteria and many invalidations that you have to follow, so that you're not just blindly following the market as a pattern trader, but you're actually taking this with data and seriousness. So the types of inducements, we have major, medium, and minor types of inducements. So let's first cover the major inducement. The major inducement is usually going to be on the daily or 4 hour or 1 hour time frame, the highest of time frames. First, we need to understand that we have to qualify a bearish market. So a lower high that went on to make lower lows in the market. We know how to qualify the supply zones. We know what a supply zone is. Price comes into it, and we start to get reactions. Price comes in, gives a reaction, but it's just bullish. We have higher high, higher low, higher high, higher low, higher high. So we have not got rejection yet. That's showing us that the market is still bullish, buyers are in control, maybe because there is medium inducements happening along the way. I'll cover that later on. You can even see it, medium inducement, that means the buyers are in control. And what does happen? Elastic band pulled, cause, effect, bullish break. Pull back of the elastic band, inducement, cause, effect being bullish break. But when we finally take out the supply zone, when we have an inducement structurally of all of that supply zone on the left, once that is taken out, then we have a real inducement. And what does that lead to? Let's zoom in on a smaller time frame. We see that price finally, after doing these inducements here to push price higher, to give these mitigations and inducements here to push price higher, eventually we take out the whole supply zone. We have a major inducement over here, grabbing the liquidity of that whole supply zone, and then the elastic band is pulled and it's confirmed with an effect, which is you get a shift in market structure, a bearish break of structure, making a lower low. So now you can come back to this area and potentially sell with a new trend, because you are trading this 4-hour bearish trend, looking for a lower low fueled by the major inducement. Of course, this is just an overview. I'll show you later on, and you've seen the videos of how you take trades based on these major inducements. But for now, let's move on to the next one, which is your medium inducement. Your medium inducement, I like to look at it as more of an intraday leading indicator, meaning my M15, my M30 time frame, my M15 structure, my M15 traps, my M15 trend lines and support and resistance. These are the areas I'm looking at. And therefore, we're not always going to take external structure. We're not always going to take these big supply zones. We might just take internal structures out. We might just take session highs and lows. We might just take high of previous week, let's say, but that might not always be a major inducement. And the medium inducement is my home. This is where most of my setups come, because the major inducements take time for it to develop. It might take a few weeks for price to arrive to a supply zone, but in the meantime, medium inducements can be pretty much daily. So I can find plenty of opportunities in a week within my trading windows, because the worst thing you'd want to do is wait for a major inducement all month long, and then it gives the major inducement, it gives the confirmation, but it's not in your time window, and then you have to wait another month for the next setup. That's why we have medium inducements, to give us high quality zones and still good trade frequency. And what that looks like is simply, before a move high in the market, you have a build up and an inducement. Before a move high in the market, you have a build up of these lows and an inducement, and once again a build up of liquidity and then a move. So this is basically confirming narrative. So this, of course, someone can just say, oh, but this is just market structure, higher high, higher low, higher high, whatever. Yes, and that's what the point of this is. That market structure movements, main moves in the markets, meaningful moves in the market, the tradable moves in the market that you should be focusing on is not just market structure alone. It's market structure plus inducements lead to the meaningful moves. You add the time window and confirmation that you need, and that's what leads to these great A plus setups. And the last one is going to be your minor inducement. This is just simply focusing on intra-session price action, your M1 and your M5 time frame, and this is nothing meaningful. This is nothing massive. This can be either an execution criteria, so you build your trade idea from other things, your major inducement, your medium inducements, but then your execution criteria of how you take an idea to a trade can be a minor inducement. For example, it's a confirmation type, or it's simply how you navigate who's in control. It's how you sense invalidations. It's how you sense where price is targeting next. It's simply how price goes from A to B in a session. And that can be, for example, price built this trend line liquidity, induced before shooting higher. We grabbed this trend line liquidity, induced before going lower. We grabbed all of this session low liquidity, induced to come higher. And then we continue, build up, induce, build up, inducement low, push, break of structure, mitigation to get in on the block, and trade opportunity. So you can see this is the living oxygen of the market. Watch all the videos in this channel. This is all I talk about. Price moves with inducements. It doesn't move randomly, and it's happening all day long on every time frame, on every currency pair, and leading to great opportunities. If you're not trading with this, sorry to say to you, but you're trading blind, because if you cannot see the liquidity, you are the liquidity. So as you can see with this diagram, I want you to pay attention. There's a lot of things you need to do to connect all of this together. It's not just simply about understanding a pattern or understanding an inducement, but this is where we'll get really advanced, and I don't want to cram it all into one video. So I implore you to research the rest of this channel, where I've given each one of these key components as separate videos so you can break it down in your own time. But the last thing I want to leave you with in this video is connecting something together so you can take it home, so that you can take it with you forward today, apply it to your trading, and see benefit right away. And that's going to be my attempt at summarizing everything that we've covered today with something actionable. And that's going to be, first, I need to understand market structure. So let's find our M15 main push. And we made a whole guide on this, so again, go watch this video. But let's say you have a bearish market and then you see an M15 switch. You see M15 now becoming bullish. And once you've seen that switch, you now see continuation in that trend. So you've now seen a lower high to lower low, now making a higher high, making a higher low, and therefore we have found a demand area. Once you have found that demand area, you can now see when the pullback is confirmed, I take 2 legs of bearish structure. Once I have that 2 legs of bearish structure, I can now look for inducements, medium inducements, to now look for sells all the way down through these supply zones of inducements, all the way down to my demand area. Same again, I get a build up, I get an inducement, let's say of Asia high, let's say into a decisional. I see a confirmation rejection of that inducement, build up, inducement, break of structure, and I sell on the mitigation with confirmation and time all the way down until I arrive to my demand area. So this gives you an opportunity to correctly counter trend trade with inducements, understanding main pushes and structure. And then once you arrive to your confirmed demand area, you learn how to refine it. I made a video on the confirmation criteria points of interest. Did it lead to a break of structure? Did it have an inducement inside? Does it have confirmations of intent? How much time did it spend in consolidation? All of these criteria that I mentioned about the point of interest, once you've refined it, you allow price to come into your refined zone, you wait for consolidation and traps, you wait for inducement, you wait for intent, you look for an entry in confirmation and time, and then you trade the new trend. And that's a prime setup. You basically look for the build-up, inducement, and mitigation in high quality zones with confirmations in the correct time. When you connect all of these things together with the Trinity, that's where you are on the right track. Because whatever you do from this video onwards, just remember, if I'm about to take a trade, yes, use your market structure. Yes, use the things you like, but just add this small tweak. I'm going to take a trade in my same way, but I'm just going to add an inducement. I'm going to add confirmation. I'm going to add time window, and I'm going to add high quality zones. Once I've connected all of these things together, you will always improve your win rate. You will improve your risk reward, and you could even go from a non-profitable trader to a profitable trader just by following these restrictions. Because as I always say, a restricted trader is a profitable trader.